the key thing now really is, as we move into the next phase of the post-COVID world, is how quickly and how successfully economies can open. And obviously from a financial market perspective, what that means for corporate liquidity and corporate earnings. So absolutely better to look in that direction. But the key is, are they getting it right in terms of how quickly economies will be able to recover?
How quickly do you think economies will be able to recover?
Oh, strange you should ask me that question. So I think we do feel that historically there's been a much slower recovery in jobs compared to how quickly jobs are lost. Now, there is a very good case, I think, to be made that given a lot of these jobs are furloughs and temporary job losses, the recovery will be faster. Then we will probably see this recovery being faster as well than normal. That looks pretty clear. But that said, if you look at let's look at the U.S. market, for instance. The U.S. market is actually back where it was in November last year now, right? So you're effectively saying, let's say we get, if earnings were where they were then, which most people are looking for around 20% decline this year, then you need to be about 20% up just to validate where we are today. Actually 25% if you do the maths. So I think there's a good case to say that markets are getting ahead of themselves here. Technicals don't look extraordinarily stretched yet. If we look at our market diversity indicators, they're not flashing red either. But we do expect some volatility and market weakness to come back in a 1 to 3 month time horizon as markets maybe come back to a more realistic view about how quickly that recovery will actually happen.
So, Steve, I wanted to pick up on that thread because are your indicators reflecting reality here? As you just pointed out, the S&P 500 is about 40% up from its March lows now, and we're only 9% away from February highs. There's a real disconnect happening here, isn't there? And now we're staring down the barrel of what could be 20% unemployment in the United States. How do you explain that disconnect, and should we expect some kind of market correction event near term?
It's actually normal for unemployment to peak after the trough in equity markets. That's not in itself necessarily that worrying. But I think some of the other points you allude to are concerning. The only sort of counterpoint to that is if you look at we talked about the recovery from 2008, 2009 being unloved. But this has also been actually quite an unloved. We've seen a lot of people really sitting on the sidelines, whether it's been our private bank customers, but also if you look at the hedge funds, CTAs, global macro guys, they haven't been chasing this rally yet as well. Now we've got volatility coming down. There is the scope for people to deploy more money into equities in the very short term before we make a high and then we see that weakness that I've talked about.
It is a liquidity-driven improvement in risk appetite, though. This is all central bank money coming into the markets, really helping to support momentum, no?
Yeah, absolutely. And we were talking, even just a couple of weeks ago, people were saying, this is a very narrow recovery. Is that something to worry about? And our answer was no. Now we're getting that recovery broadening out. Is that something to worry about? Maybe it is a little bit because, pretty much all pro-growth assets now are starting to do well. As I say, that can continue for a week or two or maybe even a month. But, I think that cannot continue for too long against the macro backdrop that we're looking at.